One of Wall Street's biggest bulls believes the market is overreacting to recession fears. Chris Harvey is the head of equity strategy at Wells Fargo Securities. Chris, great to have you with us on a day like today. You actually say that it might be time to put new money to work here on this pullback?
What we're looking for is, so obviously we saw what the ISM manufacturing did. We'll get ISM servicing tomorrow. So if we're in line or less, I would expect the equity market to start to sell off a little bit more. We get a 1-2% sell-off, then it starts to get interesting. 28.5, 28.25. It starts to get interesting because the risk reward changes, right? We like stocks when they're lower, not when they're higher. Furthermore, the setup into tariff or trade negotiation is a lot more productive. And we think something non-negative is going to come out of that, and you can see a bounce. So we're looking for that negative news to come out. We're looking for that washout to occur. And if it is, we'll look to take advantage of it.
Does your view on the trade negotiations that are coming up later this month and almost a week from now change at all, given what has gone on with the president? And again, we're trying not to be a political show, but this obviously impacts how the president goes into these negotiations.
Right. So we've always said that trade negotiation is a second half type of thing. And so as we get closer to the election, you need more and more certainty. The one thing that we keep hearing is there's so much uncertainty, we don't know. So as we go forward, you need more certainty. I think the president is very cognizant of that fact. He's also very cognizant the economy is in kind of a difficult spot. And if you put more stress on it, you could push it over. So they need some progress. And also, if you look at it, he's got impeachment to deal with. He has an economy that's slowing down. He has some more stress with overseas issues. He needs a win in the short term. And I think what he needs to do is have momentum going into 2020. And that kind of forces him to get a deal on the table. Furthermore, if you think about this, if he doesn't get a deal on the table, the economy does slow down, somebody else's name goes on a trade resolution. And I think that would be infuriating to him because he's done a lot of the heavy lifting to get a deal on the table.
So you basically turned very bullish a little bit earlier this year. Was it in April or so?
April or so. That's
okay.
Right. Yeah.
And so since then, I mean, is part of that bullishness predicated on this notion of a stock market president? Because it seems like everything that you had talked about just now when it comes to a trade deal has to do with Trump wanting to be the one to claim credit, Trump not wanting the economy to slow down further, Trump not wanting the stock market to go down more.
So the commentary before the political. So, Tim, I agree with you. Politics are now starting to come into play. We haven't really priced it in. I don't think we're ready to price it in. I don't think Warren or Biden are enough of a threat. But as we go forward, the perception will start to wax and wane. And we're beginning to see that. So, yes, if we get a change in leadership, if trade negotiations don't go as planned, if ISM serves a lot worse, then we need to rethink things somewhat. But also remember, all your bond proxies have already moved. All your low vols already moved. This is not fourth quarter of 18 where they had underperformed. This is a lot different. People have already moved into kind of a cash and can good mentality. And so the pain trade is actually for that reinflation trade to occur.
Even with all that said, in terms of the waxing and waning with the political pressures, et cetera, you still stand by financials, which you upgraded in September.
We upgraded in September. What we wanted to do is when rates are low, a lot of pain is in there, a lot of bad news. Valuation's pretty attractive. The underlying fundamentals are still okay. We had a conference. Numbers came down a little bit, and we think overall the fundamentals are in decent shape. Not fantastic, but decent. And for the valuation, we think it's a pretty good risk reward.
Okay, Chris, great to see you. Thank you.
You.
Chris Harvey of Wells Fargo. You like what Chris had to say?
Well, I liked the part about financials, right? I'm long. This has been a terrible, I don't know, week, the last 2 days, I guess. But I think that what has started as the rotation out of growth at any price toward value continues, and this is an area of, I think, very good value.
Yeah, 4.8% down in 2 days in banks. You know, someone was right a couple days ago and doesn't feel so right now. So, you know, I don't know what the right trade is on banks, but I tend to agree that the balance sheets and the value rotation that we saw, which should include banks, some of it was, you know, late cycle cyclicality, totally warranted. I do think that that's a fair trade. I look across some of the other sectors, and it's clear that the defensive sectors have been not yesterday's trade, they've been the last 9 months trade. And therefore, I do think the market is positioned defensively.
So what do you think happens, though, when you think about this, if we start to turn lower like we did in 2018 in the Q4, when correlations went to 1, almost every risk asset started to go down. When you have the XLU and you have staples, two of the best performing sectors in the S&P 500 that are trading at all all-time highs, up massively, outperforming the broad market. What do you think they're going to do? So if you're leaving expensive growth right now, what are you going to do with expensive no-growth stocks? I mean, like, to me, I heard all day long, and we had Tony Dwyer on last night talking about how different it is, and yes, and we're pricing this, and rates were down. It doesn't really matter. If the stock market's going to go down and it's going to start to snowball, these things may lead the way, and the other stuff that they've been coming out of, they're not going to go back into right away. So my point is like, I just don't think it makes any sense to be complacent 5% from the all-time highs.
So what's got me worried is that if we don't get a deal, if we don't get some type of a deal in the next week, and earnings are flat, and we start to really see the fundamentals shrinking there, I don't like the way the technical setup has been extremely negative, and the Fed does not have enough to fight off a recession this time around. So we'll know in the next couple of weeks where this market's going.
Right.
That's the weakness that I'm worried about.